Well, let's just say things are priced to go very well. Anything that goes wrong in the world, it's not in the price. Maybe, that will turn out to be fair. Maybe despite the political turmoil, actually, economies are growing.
Die Geldmeisterin. Der Finanzpodcast mit Julia Kistner.
Lewis, thank you very much. Nice to have you on Geldmeisterin. Would you please introduce yourself just briefly, because You're the first time at Geldmeisterin.
Well, thank you very much for having me. My name is Lewis Aubrey-Johnson. I represent the fixed income team at Invesco based in London. We are a team that focuses on corporate bonds, high-yield bonds, and government bonds.
Mm-hmm. So you had a really nice year in 24, or could you just summarize the fixed income market worldwide?
Yes, well, markets this year, you're never completely happy as a fixed income investor. You're always cross about one thing or another, not having enough risk in one place or too much risk in another. But actually, when I look at the returns overall, what has done tremendously well has been credit markets, the riskier the better, high yield best of all. And what has been a little disappointing has been duration. You've had some good moments, but you've also had some more difficult moments. So this year has been definitely a year of credit.
Mm-hmm. Is it because the curve was flattening, or why did you say it was so?
Well, the big consistent feature of our markets this year has been declining credit risk premia. Mm-hmm. In other words, credit spreads have been compressing across all markets, developed and emerging, corporates, high yield, subordinated, senior. Every type of credit instrument has enjoyed outsized gains this year. So sometimes yields have been going up, sometimes yields have been going down, but pretty consistently throughout, credit risk premia have been compressing.
Mm-hmm. And how come? Are the people so euphoric, or what is it?
Yeah, well, it feels euphoric at the moment. Yeah, absolutely. If you were to look at the backdrop in Europe, you wouldn't be that excited. We're stuck in this low growth environment. Growth this year, not even 1%. Yes, the region has finally got on top of inflation. Yes, there are some good things happening. Real incomes are growing. Interest rates coming down. But, Europe has some real deep structural, economic and political challenges. In the US, it's been better, actually. The story there has been resilience. Mm-hmm. Despite a very steep interest rate tightening cycle a couple of years ago, the economy continues to power ahead. And moreover, you have inflation that's coming down, and even now interest rates coming down there too. And what I think is happening is that investors of all types are wanting to lock in coupons at current levels whilst they still can, because interest rates are coming down. And they've almost stopped looking at corporate bonds on a spread basis and are just looking at the yield.
So they don't price in the risk enough?
Well, let's just say things are priced to go very well. Nothing, anything that goes wrong in the world, it's not in the price. Maybe that is, that will turn out to be fair. Mm-hmm. Maybe despite the political turmoil, actually, economies are growing at various paces, but we've avoided recession during this policy tightening cycle. That is no small achievement, and maybe the backdrop is good. Maybe it is appropriately priced. The problem we have is that you're not really being paid for the risk that things go wrong.
Mm-hmm. But why does Invesco fixed income team then think that the argument for investing in bonds are the strongest it has been since years then, if there's so much uncertainty?
Well, I think we've been gradually cooling our enthusiasm throughout the year. The backdrop is still, by and large, stable. Interest rates coming down, but the pricing, that's what I think has cooled us. So if I wanted to be a little bit more optimistic, I could say the all-in yield is still significantly higher today, even with these tight spreads, than it was 3-4 years ago. But equally, I think now there's very little additional yield that you are earning by taking that credit risk now, rather than just sitting in the risk-free equivalent.
So you avoid high-yield bonds then?
Yeah, this is a difficult question for me because we manage everything, including high yield. And the way that our investment team operates is not via a committee that has a singular team view, but by portfolio managers managing their funds and making their own decisions. And so, of course, whenever you get that, you have differences of opinion. I would say there is a split of opinion in our team at the moment. The high-yield portfolio managers, by and large, appreciate the tightness of markets, but they say, you know what, the risk isn't significant either. I'm happy just to take the yield. Our more cautious managers, those that manage flexible funds that can do a little bit of everything, they have departed the high-yield market, admittedly too early. And they say, it's just too expensive for my taste. So we have differences of opinion, which makes for interesting investment meetings these days.
Yeah, but to get to your opinion, what is your general forecast then regarding inflation? What's important for your job and the real interest rates and the economy for the next 12 months in Europe and then also
in the US? I cannot sit here and with a straight face tell you I know what's going to happen in the US in the next year. It is extremely difficult.
Don't you say this every year?
I think yes, every year we say it's difficult, but this year I mean it. The policies that Trump is proposing that in theory could have quite profound impacts on growth and inflation, and sometimes in opposing ways. I think it is extremely difficult to say with any certainty what is going to happen next year because we don't know what Trump's policies are going to be. We know we have a strong idea of the direction, but we also know that he's prone to changing policies, potentially quite suddenly. He's an extreme pragmatist. We don't know how firms and countries and individuals will respond to those policies. As best as one can estimate, you would think that we're going to see some inflationary pressure. So that whether that be through a combination of tariffs, stimulative tax cuts, or higher yields through increased borrowing, the classic models will tell you that's what we are going to get. But I think you need to be pragmatic. We need to wait and see what actually he implements and how firms and people, consumers respond.
So in practice, what are you doing? You keep your feet still and you earn cash or what?
Yeah. The first thing we're doing is not trying too hard at anything at the moment. There isn't a big opportunity in credit, so we are focused on cleaning up portfolios, getting into better quality issuers, bigger capital structures, more highly rated issuers, less cyclical issuers. Anywhere that you think could be a problem or in a difficult market could be challenging in terms of liquidity or individual name risk. That's the one thing. So we're de-risking. In duration, we are in Europe actually a little bit long duration. Here, we think things could get a little bit worse before they get better. Yes, real incomes are growing, but the backdrop feels very heavy to us. There are some real structural challenges that this region faces in terms of growth productivity, demographics, fiscal, politics, geopolitics. It's very difficult in Europe. Investor sentiment is very poor. So I think the market's pricing for a trough in rates next year at 2%. We're happy to bet that it goes a little bit looser than that. So we're long duration in the euro area.
What means long duration? 7, 8 years?
Not quite. I mean, different lengths in different products. But if I give you the classic example of our Euro corporate bond fund, so for context, let's say the corporate index is 4.5. Okay. We're at 5. Nothing too crazy because the curve is pretty flat. It would be wonderful if we had a positively sloped curve, but it isn't to be. So we can take some duration, but not a tremendous amount.
And don't you have the idea that the inflation could come back?
In Europe?
Yeah.
Not at the moment.
Not at the moment.
No. Of course, we need to see what, if any, tariffs of our own the EU produces. But even then, I don't think that's going to have a significant inflationary impact. I just don't think the tariffs will be that extensive or that high, or have that significant an impact. I think the bigger challenge is just the economic malaise feeds into a weaker backdrop, which suppresses pricing power even further.
And this you don't see in the US?
No. Well, the starting point is it's much stronger. The debate a year ago was soft landing. That was the term. It's a no landing. That's what we've seen this year. No landing. It's been incredibly resilient. We've tasked our economist, our on-the-desk economist, with trying to find holes in the U.S. economy, and he comes up with stuff. But to be honest, the big picture is resilience. It's not one of weakening. Yes, maybe you can look to some evidence of weakening in the labour market, certainly in hiring, for example. But unemployment's still very low. US citizens still consume a lot. Yes, arguably their savings have been run down, but the economy by and large is in a very, very good shape, and interest rates are coming down.
And what about the indebtedness of the US? Couldn't this be a very big challenge for bonds then, if the trust is leaving from the US and the US dollar and they have to rise up?
Yeah, could be.
Interest.
Where's the alternative though?
Yeah.
The US dollar is the world's reserve currency. The US is exploiting its exorbitant privilege. The US consumes too much, but the rest of the world saves too much. And the US is, an incredibly productive economy. Someone told me recently that the way they view the world is that China is an autocracy, Europe is a bureaucracy, and the US is a company. And everybody knows that the debt metrics are on an unsustainable path, but everybody knows that there isn't an alternative. Is the euro an alternative to the dollar? Yeah, I don't think it is. What other currency is there? So for the moment, it's a known unknown.
But still, the currency is very important for the bond yields, and now we have, as we heard from Paul, we have a 15% overweight of the dollar. So what are you doing then as a bond manager, a European bond manager? Do you have to hedge the risk of a devaluation of the dollar, or you don't think that in this horizon, on this duration of 4 or 5 years, this is a real problem?
The dollar's been strong of late. I mean, actually, what we tend to do, our operating model, is that we hedge back most of the FX risk. We tend to stick to spread and duration risk and not get so involved with the foreign exchange risk. So what we think about as a European investor, if we're buying US bonds, what is the basis risk? In other words, what is the difference between euro yields and US yields? How could that difference change? And what is the hedging cost, which also changes over time? And then what is the spread difference if I'm buying corporates? So those are the risks that we focus on. From time to time, we'll have a small dollar position. The dollar's been strong, and I think with good reason in recent weeks.
And are you overweighted for US bonds or underweighted like Paul is with the stock side?
Well, we're actually a little bit underweight because the backdrop in the US is firmer. The inflation prints just have been a little bit, at the top end of expectations, a little bit stronger. And in Europe, I just don't think you have that pressure. In the UK, we have had a little bit more inflation, but actually we're quite constructive on the UK. The economy is not strong at all. I think the inflation thing is a bit of a mirage, and yields are pretty attractive there. So we've taken a sterling position in our global funds for the first time in a long time, and we've been switching away from US into Europe.
And this is because you don't believe in the dollar, or?
No, it's just about this divergence in the economic fortunes of Europe and the US.
And did you change your mind with the end of the election, or with Donald Trump being the president now then? And how do you see that the Secretary of the Treasury, is this positive or negative?
Well, the markets took his announcement very positively, and I think that was in part about comments that he had made about wanting to get the deficit back essentially under control. He mentioned a figure of 3%. I mean, I think that's impossible anytime soon, but you could tell, I think he was giving the market a clue there. He was speaking about tariffs in a way that you felt was more pragmatic, maybe tariffs being a negotiating point rather than a blanket policy. So the markets clearly see him as someone that could, tame perhaps Trump's sort of more wilder instincts. I think the jury is very much out on that one. I think we saw in his last administration a lot of factions within the Trump circle vying for influence. We saw continual sort of changes of position, a lot of change in personnel, and I have no reason to suspect that this administration, won't be any different in that regard.
And what are the opportunities and the risk in general lurking in the fixed income area in the next 12 months?
Shall I start with the risks?
Yes.
Yeah. Okay. I'll try and finish on that question on a high note. Well, the risks are risks emanating from the US. Either policies that overstimulate or damage. Either damage the US economy or damage the global economy. And we know what they are. Tariffs, tax cuts, large increase in borrowing from an already elevated level, deregulation, war on immigration and immigrants. That could act as a very significant negative supply side shock. The labor market has grown tremendously. The working age population in the US has grown a lot in recent years due to immigration. That is one important factor in why the economy in the US has done so well. So that would be a negative. So there's lots of things that he has talked about that could have a material impact one way or another on growth. So I think there's lots of risks. But of course, actually, you could flip that coin and say that there are also opportunities in those policies. If some of his more damaging policies fade away and some of his more, let's call it stimulative policies, supply, improving the supply side, for example, deregulation, it could be pretty positive. So I think we need to approach it with a bit of an open mind.
And if you can choose between different kinds of bonds, which would you prefer? For example, in Europe, right now, there are one type of bonds which are really popular. These are these fixed duration bonds.
Yes, call them FMPs, fixed maturity products.
What do you think of them?
Well, they're fine for what they are. They're essentially, you're buying a bond product for which there is a fixed final maturity. And you are taking let's call it a modest degree of credit risk, and you are earning a modest incremental income over and above the rate of, the deposit rate. So in theory, there is some variability in the price, but if the final maturity is only 2 or 3 years away, then they are pretty stable products. They can earn you a little bit more. And I think for many low-risk savers across continental Europe, actually, it works for them. And we've seen demand in the markets emanating from those products for bonds. It's just huge. It's huge demand. Yeah.
But the fund manager has less selection for that because he has to look for the same maturity. That's not easy.
Yes, that's true. Maybe there is a little bit of management that you need to do because you don't want necessarily to find a portfolio of bonds all at the same maturity point. You would struggle to get real diversification depending on the size and what you were trying to do in the market in which you were investing. So I dare say, although we don't manage FMPs, I dare say there'll be a range of maturities no longer than the final date, and those bonds maturing before the final maturity date would just be rolled into short-dated instruments.
Are there any other trends, or are the inflation linkers so cheap that you can buy them now because everybody thinks there's no inflation is priced in?
No, I mean, there is no such thing as a free lunch. So, if there's something out there that's offering you a decent return, caveat emptor, there's got to be a risk associated with it. No, I don't think there is anything outstandingly cheap in markets. I find our big ideas come at times of dislocation and fear.
And we don't have both of them.
No, not in in bonds, for most of the time, it's pretty boring, with good reason. It's meant to be boring. This is a relatively low-risk asset class. It has its moments, but by and large, you're buying the debt of the strongest companies in the world, so you shouldn't expect a bumpy ride. But every so often in fixed income markets, you get a chance to do something important, to take risk, and to, if it pays off, to really make some good returns for your clients. I can count those. I've been in the fixed income markets 20 years. I could probably count those opportunities on the fingers of maybe one hand, 1.5 hands.
Like in 2022 when...
Yeah, exactly. COVID was a classic example. I mean, well, we had COVID, which was truly awful in a completely different kind of way, but then, extremely positive for bond markets given the monetary policy response. We then had to grapple with the inflation shock, the geopolitics. That made it a pretty rough ride, but there was a couple of good moments there for us to do things. And then if you look further back in the history, we've managed through financial crises, currency crises, deflation, inflation, everything that the world throws at you.
But you need this disruption in bond market to get opportunities, if I get you right.
Yes, to get a big opportunity. Yeah, for most time, bonds are boring, and they should be. You get a little bit of extra return from buying corporate bonds, and a little bit more still if you're buying high yield. There is some default risk.
How will the capital markets in general move next year?
It's probably stating the obvious, but we can't have another year in credit as good as the one that we have just had. Yeah. So your first assumption, which is a safe one, is that at the very best you are going to get your yield. I wouldn't place any money on spreads going, significantly tighter. They're already at the record tights. You'd have to be betting on an extreme pricing being even more extreme. And if you're right about that, how much are you going to make by being right? So I think assumption number one, credit at best gives you your yield. The next challenge is to think about duration, because the yields could go up or the yields could go down. You could still make money in your corporate bonds, but it's going to require yields going down, government bond yields going down. Now, in the euro area and Europe, actually, we can see that happening. Backdrop just feels too soft, and it's, I think, a good bet that the ECB is going to have to go beyond a neutral rate. It's going to have to get to an outright accommodative stance in monetary policy, yeah. So there, I think there is room for bond yields to fall. In the US, it's a much more open question. The backdrop is stronger. There is this residual inflationary pressure. Yes, there are some parts of the economy that are showing signs of softening, but Trump is talking about stimulation. And then, of course, to make things a little more confusing, that sort of flies in the face of my pro-euro duration stances, of course, oftentimes bunds, European duration, is just a lower beta version of the US duration. So if we get a nasty sell-off in US treasuries for whatever reason, I think it puts upwards pressure on Eurozone yields, even if the backdrop is weak here.
And when do you see it? After the presidency is really on Trump's side, let's say in March or before, or when is there the most risky?
No, I wouldn't say that there is a particularly most risky point, because as we've seen in recent weeks, actually what can really move the bond markets is just the daily grind, the data that comes through, the evidence of where the economy is and where it's heading, and frankly that's been much stronger than expectations in recent weeks. And you only have to look back a couple of months ago to see where the US Fed funds was priced for next year, and most of those cuts now, a good proportion have been taken out. So, and that's not related to Trump. So next year you have all of the fun of the Trump policies and what he's saying in any one particular week, on top of the regular job of trying to work out what's going on in the economy. So yeah, I think it's going to be an interesting year next year, and maybe one of which active managers that can change the risk profiles quite quickly may actually end up enjoying
So you see the big opportunities again.
Well, let's not get ahead of ourselves. There could be we would not shy away from volatility.
For sure, you don't get bored, I guess, Lewis. I wish you good luck in managing the bonds for Invesco, and see you next year again.
Thank you very much. Very nice to speak with you.
Alles Gesagte ist nur die persönliche Meinung von Julia Kistner und daher keine Anlageempfehlung und keine Rechts- und Steuerberatung. Für Verluste, die aufgrund von getroffenen Aussagen entstehen, übernimmt die Autorin Julia Kistner keine Haftung.